What is the current state of the Chicago real estate market? What is the best way to buy and sell in a competitive market? Why should our listeners be concerned with commercial real estate? What can our clients be doing to be most competitive in that market? Okay, we are back. I usually say I'm excited. I'm like uber excited. We have the one, the only Miss Dina Zimmerman. Dina is the principal with, I'm going to screw this up, Baum Realty.
Perfection.
She has been an expert in the retail commercial side of real estate for the last 2 decades. Obviously, in the residential world, we are in very different aspects of it.
Right.
And I think a lot of our consumers are going, I don't really care about the commercial side of things. But the reality is there's a lot of connection between the two. I'm going to dive right in for our first question, which is essentially that. Why should our listeners be concerned with commercial real estate in general?
Well, I mean, if you think about it, my favorite saying with commercial real estate, especially, and as it relates to what you do on the residential side, I mean, real communities are built around live, work, play, right? And it's about communities. It's about gathering. And, I'm sure when you're selling a condo or a home, people are probably asking you, where's the closest grocery store, convenience store,
the bar,
pharmacy, the bar. I mean, that's the first question I'm asking. And if you're not finding that nearby, chances are that's probably reflective in the prices of the homes that you're selling as well. And, for me specifically with retail, that's the first question we're asking. Tell me how many rooftops are in the area. What's the median income? I've asked you that question, actually, what are you seeing for condos selling in this neighborhood? Because I have a retailer who's looking there. And then you think about the office side of things, right? And I know everyone's like, oh, office is so depressed. Well, office is just different. It's just pivoting.
I go into the office every day still. I'm putting that out there.
Yeah, and a lot of people do, and a lot of people are. And I think a lot of it is because it's going back to this concept of people want to be around people,
other people,
whatever that looks like. Yeah. People want to gather, but also people want to be in an office environment and collaborate and be together. And if you think about that, it's just different. It's hybrid. Maybe people aren't there all the time, but they're still going in.
I think there are so many good topics on what you just hit in on. One of the things that I always like to explain to my clients is that what people love about Chicago on its most basic level in its neighborhoods is that our zoning is totally screwed up.
Don't get me started on that. The zoning is totally screwed up.
What people love about our urban neighborhoods is that you can walk down a street. You can have a library. Mm-hmm. You can have a bar. You can have a dry cleaner. You can have a single family home and an apartment complex all on that same block.
Yep.
That's what creates, I call it the blend lifestyle, right?
I love that.
The reason that our consumers don't just go to the, suburbs and just go to the point where they're going to be driving everywhere is they want to be on foot. They want to navigate. They want to have every city convenience at their fingertips.
Yeah.
But they also want to live in a nice place and a nice area, maybe a tree-lined street. So the fact that they're looking for that commercial residential balance is a huge aspect.
It's a huge aspect. And when you look at, Chicago specifically and the neighborhoods, I mean, I make a joke about this, and I'm probably the worst because this is the business I'm in. I'm in the West Loop, which in my opinion is the best loop. I stay there though, because I've got my Mariano's, I've got my Whole Foods, the 3 different gyms that I like to go to because I love my Class Pass and all of that. But what's great is if you're in Lincoln Park, if you're in Lakeview, if you're up in Ravenswood, wherever you're at, while the neighborhoods are so unique and different, all of those amenities, all those things that we love, they're all the same. Well, and even if I'll have retailers say, oh my gosh, it's only a half a mile. Yeah, a half a mile could be 20 minutes. I mean, you're in a totally different, almost a totally different city, right?
I always say that our neighborhoods can check every box.
Yeah.
But they all come with a little bit of a different personality.
100%. So then how does that match your personality? But otherwise, all the flavors of the stew are still there.
And I think the other thing off of kind of what you were alluding to is that what we see on our side is that the commercial isn't the trendsetter.
No.
They follow the residential, right? So if you're ever trying to figure out where that next neighborhood is, if the commercial's already there, you're not the pioneer.
I love that. I say that to my investors all the time. And we've, of course, we didn't rehearse this. And it's so funny because that is what I say to my clients all the time. we follow residential.
Yeah.
All commercial, but specifically retail.
Yes.
And if I have an investor looking for a mixed use property, for example, they love that where you got the apartments above and you can have that, retail on the first floor. And we'll get into taxes in a minute because that's a great investment for those who are like concerned about commercial taxes. But the first thing my investors always say, who lives there? Are people living there? Are people moving there? And if they're just starting to move there and you don't see the commercial, that's where we want to pounce.
1000%. Okay, I'm going to move on to this next piece because in our post-COVID world, and I'm happy to be saying that, even though we're in some sort of tailspin from it, I know there's been a lot of talk about the wrath on the commercial real estate. What is the current state, in your opinion, of the Chicago real estate market? And then how does that compare to other metropolitan areas?
So that's a great question. As it relates to office, because we're a big urban city, much like I'm going to compare it to New York and even LA to a certain degree.
Our winters are exactly the same as LA's.
Yeah, totally identical. Office is still struggling. The vacancy rate is not great.
Yeah.
But I will tell you, even just from 6 months ago, it's definitely getting better.
Yeah.
And we are tracking that hardcore because I work with a lot of the QSR, the fast casual food users. And last week, and this is so ironic, last week I had two of them. One traditional retailer and one a food user. I want to be in the loop. I'm like, you're the loop? And they're like, the loop. Let's
I
start
can get you a deal.
And that's the best part. We can get some great deals, but there is that confidence that people are coming back. We also have the tourism, which helps.
Yes.
I love being in retail because, of course, we were the most beat up asset class within commercial during the pandemic. Oh, look at all these stores closing. Yeah, but retail is evolving and it's ever changing. And right now it's the hottest, not just nationwide, but in Chicago, it's one of the hottest asset classes. There's vacancy rate is only 4%, and 1% of that 4% is main on main.
So let me ask a couple of questions on that. Let's put it at the worst point of COVID, let's say 2021, right?
Yeah.
What was vacancy rate about in Chicago?
That's a great
Nobody knows the
question.
answer, so we can just give a ballpark.
Let me just put it this way. It was not good. But you know what? Also during that time, I was doing, thankfully I do leasing and sales. We were doing I do primarily leasing. We were doing so many leases during that time because there was a confidence that we were going to come back to. And a lot of that with the vacancy rate is because there has been no new construction. So we're having a really, really hard time.
So you guys are seeing that in your world, just like we're seeing it in ours.
Yeah.
There's no new build.
There's no new build. And it's really frustrating because, I represent a lot of national retailers and they need space like yesterday based on expansion plans. We can't find it.
Yeah.
And of course, industrial is doing, look at Amazon, FedEx, all of it. They're doing killer.
Yeah. In general, if you were going to kind of summarize how Chicago's doing in comparison to some of the other cities, would you say we're on par? Or maybe we were beat down a little bit more and our comeback is stronger than our setback?
I would say the latter.
Yeah.
For a number of reasons. And listen, we have to talk about it. Taxes, the tax situation here, and the perceived but yet not perceived with crime.
Yeah.
That is a big topic of conversation. Lot of investors, a lot of retailers are pulling out of Chicago and they're going to other markets. But then that being said, you've got a lot of groups from the East Coast that have such a confidence here because, again, New Yorkers look at our taxes. I'm using them as an example and in the best way possible. Please keep coming.
It's a drop in the bucket.
It's a drop in the bucket.
Yeah.
Right? Where, and I say this with taxes because, for example, retailers are paying, you look at ground floor retail, they're paying not just a base rent, but they're responsible for their proportionate share of taxes. And I literally had a listing I just gave up in Lakeview. The taxes were more than the rent. The taxes were more than the rent. And that's an uncontrollable cost. That's not your fault. That's not my fault. So what am I going to do then for my tenant? I'm going to beat you up on the rent. Yeah. But you bought this wanting to make money. Right? So I think that's the biggest problem that we really need to figure out right now.
Is how to navigate the tax world.
Yep.
I can understand that for certain. And that is a perfect introduction to our next question. Essentially, is just that, is with all that we've seen on taxes in the commercial world, really what is the biggest impact and how do we navigate past that?
I think it's property owners continually appealing and fighting their taxes.
So that can be done just like with the residential.
It can be. It can be. And it's really interesting how many, especially out of state, because there's so many out of state landlords who own property here who just aren't educated in that.
Yeah.
And I think it's understanding that that's going to be a big pressure point, especially for those on the leasing side, but also in terms of investing. I'm selling a property right now. I'm actually touring it right after this. The taxes, we're talking, it's a 3,000 square foot building, $80,000.
Wow.
So either he has to reduce his price or we're getting creative, and we have a lot of nonprofits who are looking.
Sure.
Which is a great space for nonprofits who are looking to expand right now because they're not subject to property tax like other investors are.
That's interesting. So do you feel like there's been a surge in the nonprofit world to try and take advantage of maybe prices coming down because of taxes?
Absolutely. Like personally, yes, I have never seen more in that space, and actually pivoting from leasing to purchasing because, they own the asset. It's a great investment, but also they're not subject to that tax. So that it's a really interesting thing to be tracking because we are seeing a lot more
for certain
in the nonprofit world, schools, churches, what have you.
And it's interesting because we see the same thing in our world, right? On the residential side, if we have a property that has been maybe misassessed, where the taxes are exorbitantly high for what it is, we see that because consumers look at cost, right? My consumers are looking at cost. Your consumers are looking at profit margins.
100%.
And with that, we see that the price gets driven down because they have to make sure that cost is reasonable. Now, when my buyers are assessing these properties, and I've had some people do very well in this space, I've said to them, this tax, in my opinion, is so out of whack that I believe, I don't know, but I believe that if you get into this property at a very reasonable price, take the discount on the price, and then start fighting the crap out of the valuation with the county, that at some point that should come into some more realistic value. But they also have to move forward in that knowing it may not.
Exactly. And we advise on the very same. And actually, I have really great tax attorneys I work with where I'll bring them in early and say, in your opinion, and again, we're not going to hold you to it because you never know, but how do you feel
Attorneys
about this?
love that.
Of course they do. but also it gives an investor confidence one way or the other. Either I'm moving forward or I feel really good moving on from this.
Yeah. Here's another deviation. You touched on the point that our downtown office space has been struggling, and not just downtown, but in certain aspects, the getting people back to work has been hard. Are there some redevelopment plans for that space? And is there any real kind of ideas or strategies that you think are interesting from your client's basis?
Oh, I do. Taking the huge office towers downtown aside, and some of them are filling back up. I mean, not 100% obviously, but people are coming back down. It's interesting how many are now looking at, especially since so many people moved to the suburbs.
Yep.
You're looking at some of these smaller boutique office buildings that people are buying at a great discount rate. People are now starting to follow notes that are in default. And those smaller boutique offices, have a lot of opportunity for great either conversions to condos or apartments. And especially a lot of them are in great locations near the interstate. So you can get downtown, whether they're by a train, what have you. And I'm not seeing that just in Chicagoland, but we're seeing this in other markets too, where they're looking at what can we do with some of these older office buildings. And as long as the floor plates work, it's a pretty hefty conversion, but it makes a lot of sense in a lot of these communities.
Do you think, and I know that this isn't your full world, so I'm kind of putting that caveat out there. Do you think that there is a way to venture into repurposing some of those big office spaces downtown?
I do. And, obviously they're talking a lot about like this LaSalle Street project. And a lot of people think, he's out of his mind and their lofty goals. I love it. But the interesting thing is that I've been asked this on several podcasts, and actually I was on a panel recently, what do I think is going to be the tipping point with that? Well, there's a gazillion things, right? But the one thing I can speak to is you got to get the retail down there.
Yeah.
Because if you get, whether it's the small format grocery stores, the QSRs, even traditional retailers, medical office, all of it, you need that down there because where are people going to go move and live, right? So I think it's getting that buy-in, and that will be one really, among many things, a rather large spark, in my opinion.
Yeah, and I just think, right, looking at the fact that my residential world is so is experiencing a drought on housing, right? We're so dry in inventory, and that there are buildings that are sitting not as full as they should be. Like, is there a way to take those two problems and find solution, knowing that it's a huge undertaking?
Yes.
Also knowing that Chicago doesn't make it so easy for developers to take on that undertaking. No.
But there actually, your lovely husband and I chatted about this yesterday, because it goes back to this whole concept, seriously, of live, work, play.
Yep.
And we are seeing, we talked about the Gulf Mill Shopping Center, that redevelopment. There's several Macy's, and obviously the shuttered Macy's,
or for us older folks, Marshall Fields.
And by the way, I will always call it Marshall Fields. It's like Willis Tower. No, it's not. It's Sears Tower.
Yep.
But you're seeing this. This is just an example nationwide where they're taking some of these vacant big boxes and they are turning them into, they're looking at it way bigger picture, way outside the box. And it's starting with residential, micro units, apartments, luxury condos, cool lofts with cool co-working maybe in between, and some, really cool activated experiential retail on the first floor. And I think we're going to see a lot more of that, especially when we've got the Gen Zs that are getting into the workforce.
It's kind of interesting you bring that up. I have I've worked with a couple in the field, but I have a client right now who is I'm going to screw this up. He is a traveling nurse.
Yeah. Oh my gosh, it's a
huge market. And he told me that he's currently living in, as he calls it, a glorified and adult dorm for other transient nurses.
And we're seeing this all the time. There are concepts like the Saunders of the world that are doing this. And I think it's actually really cool. It's a great solution, especially for those just getting out of college who want to live somewhere cool and hip, and it's a bit more expensive. But yet, you're not, let's face it, you're not hanging out in your apartment that much anyway.
No.
You're meeting people when you're in this like communal kitchen.
Yes.
And, under that rent that they're paying, everything's included. The toilet paper, the paper towels, the garbage bags, the things that you just don't want to think about.
And let's say they're way nicer than the youth hostels that I lived in when I was younger.
I said the same thing. I said, hello, have you seen some of the student housing in some of these colleges? Those dorms are way nicer than like the last apartment I had.
Oh my God. My best friend's daughter, who is, she calls me mom too. She sent me pictures. She's a freshman in college. She sent me pictures of her dorm room, which is nicer than half of the apartments and houses that I lived in until I was probably into my 30s.
Yeah. But I do think that's going to be the trend, because actually you talk about student housing and we're in that space too. And I have some developers who are getting more and more into the student housing space, especially in Chicagoland.
Yeah.
That's another really potential great solution to backfill some of these vacant, kind of funky, whether they're office buildings and, quasi-industrial, what have you.
I feel, and I'm not in the space, but I'm curious to know, I feel like we're at the brink of a lot of evolution in that space, just based on this kind of closing this COVID chapter, emerging new and improved. I say to people, and I think that you probably agree with this, I say that COVID was housing evolution. It caused housing evolution. It caused us to look at how we live and how we work differently. And now we have to find solutions to navigate that.
I could not agree more. And I think, with that evolution and with that, people getting more and more creative and getting into the space and just understanding how people, again, I'm going to say it, live, work, play, your 3-part day, morning, afternoon, and evening. I think we're going to see a lot more creativity coming because of COVID. One of the silver linings of it, right?
For certain. No, we've talked a lot about on this podcast about some of these silver linings that we've had the ability to experience. And I agree with you. I think there's some really interesting things coming out in both of our worlds based off of that.
And people hate that word pivot, but that's exactly what it is.
For certain.
Right?
If you can't pivot, you're getting left in the dust.
Exactly.
Okay, I've got one more for you. And I know we've touched on this a little bit, but right, I always like to say that generally we are, even if we're not, but we're kind of selfish people. How does it impact me? That's what we think, right? Even those of us that have huge hearts that want to do right by everyone else, we're always concerned with how it impacts us. So what I'm curious to know from you is, how do you think the current commercial real estate market really impacts the small businesses and the retail that we all love and that make up our neighborhoods?
I love that this is the last question too, because this is my most favorite. And it is, but it's also, my bread and butter. I love working with the local entrepreneurs,
Yep.
the mom and the pops. I mean, that's what makes all communities, but especially like cities like this.
For certain.
And that's where I am the most concerned, though, specifically as it relates to restaurants. There's such thin margins anyway. I mean, you're looking in the Loop, and some of these, Michelin chefs are closing, right? The James Beard winners, they're closing their restaurants for various reasons. And I am very, very concerned with, especially because of taxes.
Yep.
It's affecting the mom and the pops, the local businesses.
Yeah.
And
It's not going to affect the big bucks.
No, it's not going to. And you'll be a blip for them, certainly. But they, again, they can find ways to pivot. But, when you've got a local group that's got one store, maybe even a handful of stores, every little increase in taxes, any little blip with crime, anything with consumer confidence that goes down, it affects them more than anyone else. So let's shop local.
Well, and I think that's right? What can we do as a community? We love this about Chicago, right?
Yep.
We just talked about how we love the ability to go Red June Coffee Shop. It is my favorite coffee shop in the city. You guys do amazing work. It's owned by an amazingly beautiful, strong, smart, educated woman.
Yes.
That I adore. Like one of the things during COVID, right? When COVID went really impacted, that neighborhood came out and supported that shop and that business owner because we all wanted to see her succeed. And I think there's a huge lesson in this, right? We're acknowledging here that we're still in some follow-up chapter of COVID, right? We still are dealing with a lot of byproducts of it. And we love the fact that we have these local businesses. But the reality is if we can't support them, then there's nothing we can do.
And we're post-COVID, certainly, but yet not that far out of it. And there were a lot that literally last year, I have to look at P&Ls all the time.
Yeah.
Last year, 2023, for a lot, especially I'll use a great example, the fitness world, small boutique. I mean, they just finally, the ones who were able to, because there were many, they were just so devastated they had to close, finally just got, quote unquote, caught up. And maybe they're now just starting to make money. So it is shopping that local.
Is this what it looks like when you're doggy paddling?
Yes.
Heck to keep your head above water?
And I think that that's how they felt. But I will say because of that, when we're dealing with landlords, there has been more creativity in keeping businesses open on the landlord side too. And if anything, people are coming together faster, like as brokers, right? We're sort of the middle ground, the in-between.
The liaison.
And I like, that's a better word. But what's great is I'm bringing parties together more early on where I'm actually getting this side and my side on the phone sooner. And it's and actually always Zoom if we're not doing it in person, because there is something about this that, please help me with my business.
Yeah.
And I think that that's really important. So it's shopping local and...
well, and just all the things. And I'm as guilty as much, especially because I've got young kids, right? I don't go out as much as I used to. So supporting the restaurants, one of the things that we do a lot, right? We're not as good at going out to the restaurants because it can be a little bit of a ordeal between the kids' sports and everything. But we do takeout, right? We want to support those because the reality is what we love about our neighborhood, what we love about the neighborhoods in Chicago are these small business owners, right?
Yep.
And so I think that it's ever so important for us to be doing our part as a community.
I love that.
To support them.
And I want people to spread that message too.
Totally.
And be nice. Kindness always wins. So, but do the Yelp reviews.
Right?
Right? I mean,
so simple.
People rely on that so much. And I used to be terrible about it, but it makes such a little thing. You're right. It's so simple. It makes a huge difference and can literally make or break a business.
No, it's so true. And right, that's what I want to end on. I want to end on, everyone knows that kindness and gratitude are like pillars in my life, right? I wake up every morning and I count my blessings and I wake up with a grateful heart. And how can I do better? Trust me, there are a lot of moments that aren't as kind. There are a lot of moments that I'm taking a few steps back and going, wow.
Yeah.
But the reality is at the end of the every day, we are blessed, we are fortunate, and we have to be grateful for that. So as we navigate from here, I'm going to do my best to navigate with a kind and grateful heart. Dina, you are a treasure.
So
I adore having you here. We could probably talk for another hour.
Oh, totally.
But I'm going to wrap it up on that because that's such an important message. Okay, we are back at it, and we have one of my favorite guests of all time who actually comes back to visit us again and again. we have Mr. Dan Geldum. He is the Senior Vice President of Mortgage Lending at a company whose name changes more often than I can keep up with it. Today, we're calling it Rate.
Yes, it is Rate.
Formerly known as Guaranteed Rate. Is that kind of like Prince?
Yeah,
the
great.
artist formerly known as Prince?
Totally.
Anyways, Dan, thank you so much for coming back.
Thank
You
you.
are my most trusted resource in the lending world. It has been a heck of a year. We're looking into the next.
It's definitely, I mean, the last few years have been crazy, right? But now
That
we kind of
is the understatement of the decade.
Right.
Anyways, I'm going to jump right in because we've got a lot of things to get through and I want to make sure that we get all of our questions answered. There is no surprise that we are expecting another competitive spring market. What can our clients and our consumers be doing to prepare themselves from a financial aspect to be most competitive in that market?
if you're thinking about buying a house, you have to be pre-approved, right? And everybody always is a little bit worried. I say always in the past, they've been worried that I can't have my credit checked. I can't have my credit checked. Well, we do soft credit pulls now for our pre-approvals.
Explain that to people because I know there's a lot of confusion over what is a soft credit pull.
Yeah, so soft credit pull it's literally like it never happened, but it gives us all the scores and all your current debts. The scores are really close to what the hard report is. Oftentimes it's 100% exactly what it was, but it allows us to actually do our jobs, to talk. It gives us credit scores, so we can talk rates, we can talk down payments. It allows us to do our job and officially pre-approve someone just without that credit ding. Because if you get pre-approved in December, let's say, and you don't buy until July, in the old world, you'd have to get your credit checked again. Now we don't. We keep updating the soft pulls.
So a soft pull is kind of like going to Vegas. Whatever happens there stays there, and it doesn't have impact on what you do all the time.
I'm totally taking that.
So we've talked about this concept ad nauseum, but we have to say it again. To be competitive in this market, right? And we know it's going to be competitive. Aligning yourself with a mortgage professional, a reliable, reputable mortgage professional is like the first step possible.
Yeah, I talk to a lot of people who, if they're referred by you, it's golden, right? I'm typically the first conversation, or one that, they've talked to somebody else, but it wasn't, on the level that
one of those pesky online mortgage lenders.
Exactly. The ones who don't return emails, who are hard to find, right? Things like that. But it is about with whom you work, especially in Chicago, right? At Properties, Rate, they help win deals, and they're both trusted names. So getting a reputable company behind you on the lending side is absolutely needed.
We're coming off of Q3 and Q4. It's a slower time. Those things aren't quite as important. But when we get back into that competitive nature, who you're working with on both the agent and the lending side is so important. If I'm looking at 5 to 10 offers, the first thing that I do is I look for reliability and trustworthiness. Hopefully I know the agents and the lenders in it. I do most of the time. But if I don't, I'm absolutely looking for the companies that I know tend to have more professionals working and aligning with them. 100%.
Yeah, it's and it really does cost people over time. You just said it. Your offers aren't paid attention to, right? If they don't know the company. And yes, if I were shopping for mortgage, I could shop it till for 48 hours straight, right? I'll eventually find some rate that's so good, it's too good to be true. And 98 times out of 100, it is too good to be true. Lenders hide fees. They hide points. They do all kinds of stuff. They don't mention it, but they quote the rate with it. Yeah. Right. So time and time again, I often will take somebody's numbers if they question what I tell them and pick it apart and say, nope, that's wrong. That's wrong. They're adding fees that don't exist in Chicago, whatever the case may be. Or in Chicago, they forgot the transfer stamps.
You buy your way into Chicago and you buy your way out.
Yes.
It's a relative comment.
It's a big number, right? Yeah. It's a big closing cost that needs to be discussed, because a lot of times I've talked to people as the second or third person and I mention transfer taxes and they're like, no idea what you're talking about. It's mind-boggling to me that people can be in my job and not actually talk about.
There's a lot of smoke and mirrors,
yes.
Right? It's not always as clear and transparent as it should be. But I actually want to take a step back because I know you mentioned before about that soft credit pull. I want to go back to that for a second because I think people are nervous about that. But I think the point that we kind of tiptoed around was There is no such thing as starting too early, right? There's no like
anymore.
aligning your team, finding your people. People just don't come to us and say, okay, I'd like to buy a house next week. A lot of times we're working with these people for 3 to 6 months to put them in the best position, because hopefully not the case, but I know sometimes you do that soft credit pull and sometimes there's something a little pesky that needs to be cleaned up on that. And you work with your clients so that 3, 6, 9, 12 months later, they're in the best position possible.
Yeah, we can identify if there's collections on there that aren't correct, or there's some late payments that they thought they had fixed that they didn't. We can also, we can look at their debts and reallocate them. If they have one credit card that they use exclusively that they aren't paying down because of a bonus or whatever, we can move some of that money to another card and improve their credit scores. So we can dive in. I can dive in and tell people in like the percentages of likelihood of if we pay a card to 0, what's going to happen to their scores. Because in the conforming loan amount space, anything under now it's $806,500. Credit scores matter huge.
Right.
780 is different than 779. 760 is different than 759.
Yeah.
So little changes like that make a big difference. And we can not only can we fix it beforehand, we can also, if we have a quick closing like we've had in the past, we can get somebody fixed in a week and get their credit score updated, get them a better interest rate.
So everyone just heard it here. Dan has a crystal ball and he uses it to help improve people's financial credits. You haven't used it to the lottery yet, right?
No.
Okay, we're going to work on that.
Haven't figured that one out.
Is there anything else that somebody really should be doing right now that is looking to buy in a competitive market to put themselves in the good position, or do you think that we really covered it?
Let's go to first-time home buyers.
Okay.
They have a ton of questions. So if they need to talk to you, they need to talk to me before they really kind of dive in, because we can immediately dissect whether or not they qualify for certain first-time home buyer programs.
Sure.
Over the weekend, had a client that I helped, parents from Indiana that moved here. I helped them close on a house in 10 days. Their son is buying a house. He and his wife got pre-approved, didn't like the numbers they were hearing from the mortgage person they were using. His credit score was like 743, which is way different than her 800 plus.
Yeah.
That was hurting. Combined income was $210,000. Her income was $145,000. And as you know, we have a first-time homebuyer program where if you make in the 6-county region here, if you make less than $155,000 and change, we can give you $3,000 towards closing costs.
I think I know where this is going.
Yeah, we excluded him from the income side. He's still on the mortgage. We excluded him, gave him $3,000, and gave him a rate that was a half a point better because it was a first-time buyer program that didn't pay attention to credit scores.
For certain. And just to point out, he didn't get taken out of the property just for the angry spouses out there. We have a lot of clients that sometimes it doesn't make sense for both of them to be on the mortgage, but they're both obviously going to be on the deed and they're both owning the property.
Yeah, in this case, he's on the mortgage too.
Oh, he is?
But we took his income out. We can keep him in there, right? Like that was the first conversation. Maybe we don't need him. It was a total like checking every single box, and they were the, is it too good to be true?
Right.
And yes.
Yes,
This was the 2 out of 100 that yes, it was too good to be true. And it is too good to be true.
Well, we never want to be the ones to say, oh, I told you so. But man, it sure feels good when you can save the day like that.
Oh, it's always fun.
I'm going to move on to a very, very hot topic. I am certain in this part of the conversation, we're going to offend many people. That's just what this type of conversation is. We're going to talk politics for a second. Or at least let me rephrase that. We're going to talk about how politics are going to impact our financing in the new year. We are taking on Trump 2.0 administration. I'm leaving all commentary on that aside. How do we think that's going to impact our financial world in 2025?
A lot. That's a simple way to put it. But from a mortgage and real estate.
Yes, we're just talking about that.
Simply put, Trump's a real estate guy. Loves real estate, borrows a ton of money, hates high rates.
Yep.
So 2 things that we like. During the election during the election process, talked about tariffs. Yep. Tariffs are a bad thing. They're inflationary. No matter which way you cut it, they're inflationary. Inflation is the arch enemy of rates, right? More inflation, rates go up. That's why rates are at where they're at now, because of inflation. So the tariff side is something we think about. One of the things that is coming, it's coming out. There's two things actually. Fannie Mae and Freddie Mac.
Okay.
They're who we all like in the conforming loan space. That's who gives us, and outside of FHA and VA, everything is written to Fannie Mae and Freddie Mac guidelines. They're a quasi government agency now. They're backed by the government.
So just to explain, they're kind of the powers that be and govern within the financial lending world.
Yeah, and they issue the bonds that the market buys to give rates.
Yep.
Right? So they're essentially owned by the government now. There's thoughts that they may go private. If they go private, mortgage rates go up by 3/4 or 1 point overnight if they go private, because they don't have that implied government backstop.
Okay.
Right? So people are going to sell it. They don't want those things.
Yep.
So there's mentioning that may happen.
Okay.
Let's hope it doesn't. The other thing is there's and this is really stupid finance dork stuff.
We love dork stuff here.
But there's a thing called Basel III. It's a oversight into the banking world around the world, for ease of way to put it. Basel III was seen as a very bad thing for banks. It limited the bank's ability to do things that they want to do, how they lend money, all of that kind of stuff. Well, they're thinking that that's going to go away, which means banks, and this was this came off of a discussion that our head of capital markets had with Wall Street investors at what they call a trade show, where they go out to New York, people wine and dine them, talk about all the stuff that we're selling to Wall Street. If Basel III gets reduced, kind of pulled back or eliminated, ARMs are going to come back into the market. Okay. Right? Like a 7-year ARM specifically, because banks are going to have an appetite for shorter term money. Now ARMs have kind of gone away over the last couple of years.
They haven't been compelling.
Right? But they're going to come back into vogue, which is great, right? Because it's going to give people more options. It's going to give those first-time home buyers that are going to move in a few years, right? If we can get a better deal on an ARM, no reason not to take it. So there's things like that are going to be, potentially a good thing for our worlds.
Obviously, everyone has their own thoughts and opinions on Mr. Trump. There will be impacts. There is, I think, an opportunity for a lot of those impacts to be positive, right? As you mentioned very, very eloquently, we are in his space, in his world of what he likes to play in. So I think that there is an opportunity for that. There's a couple things for us to be aware of and to keep an eye on. But I think realistically, our real estate world could benefit from some of his decisions. And once again, that's no backing. That's just speaking what we speak about.
And then that goes back to what we talked about regarding being prepared to buy, right? If you think it's going to make things better, but you're ready to buy now, get a better deal on the house, refinance that rate, right? Because you can always, in theory, you can always refinance. I would say don't be worried about what happens if.
We're gonna touch on that very quickly. So I'm gonna transition into our next question. We're starting to get a little bit more into that. How do we think interest rates might affect the buyers in early 2025?
Yeah, I think you're gonna see rates are gonna probably be relatively stable. Mm-hmm. And 5 years ago, relatively stable meant like legit stable.
Right. Not up and down.
Now it's up a quarter, down a quarter.
Yeah.
Right. But we're thinking that rates are going to be range bound like they typically are.
Yeah.
They're going to be on the high 7, on the low 6.
Okay.
If we see something that starts with a 5, right, in the 30-year world, because 15 years is always going to be lower. But if we see something, and then if ARMs come back, right, then we're going to see, if we see something that starts with a 5, I think you're really going to see the market start to take off.
Well, and that's what you were talking about before. And I think this is ever so important, right? You're really educated lenders and real estate professionals have been preaching this for the last year, if not longer. When the rates become more compelling, this is not an if or maybe or a possibility. When the rates become more compelling, there are so many people that are sitting on the sidelines that are going to say, okay, I'm in. They are going to jump into the market. And that is going to be crazy. Mm-hmm. And that is going to push prices up. So you could either be a part of that aspect or buy now with a little bit of a higher rate. No, don't buy something that you can't afford for the next 12 to 24 months. That's not the kind of advice we give here. But maybe stretch a little bit to get into something so that when You refinance when that rate comes down. Now you own that house for the better price.
Yep.
And for that versus literally paying the same amount because that price is going to be higher when you get to it. It's just good advice. So what I see and what I'm expecting this year is that you've got those that are getting this advice, and good agents and good lenders are explaining that concept to people. Those are going to be the people that are sitting there ready, waiting for more properties to come out and ready to pounce, knowing that half of the market is kind of sitting and waiting to see that number 5.
Yeah. And I mean, and you think about it, like when rates dropped, what was it, 4 or 5 months, like the second half of 24, when rates dropped there for about 3 or 4 weeks where they were really nice, you were copied on the emails to our past clients.
Yes.
It was like, we're ready to go. Like, let's go.
Right.
Like, it's time to refi now.
You're now going to own your home for $400 less a month.
And we saw a ton of clients that saw some nice appreciation because they took the advice 12, 18 months ago to say, let's buy now because we can always refi later. So no crystal ball is perfect. Things happen. But as we've seen, it's waiting only, number one, you eventually run out of steam. Right. But they need to have those conversations. They need to be ready to go on the mortgage side. And then they need to be ready with you on the real estate side to understand multiple offer situations, appraisal gap, things like that they might not know especially as a first time buyer. That's the stuff that helps.
Well, and I think it's so important to address the idea and the fact that, and this is the conversation that I'm having with my clients. I have a lot of clients that come to me and say, well, we'd like to save up a little bit more money so that we can buy more. And we'd like to buy then in a year or two. And the one piece of advice that I'm giving those people is that I will never pressure anybody into buying anything. Anybody that's worked with me knows that. In fact, I'm probably the opposite.
Yep.
That being said, I don't want somebody to take that path and then in 1 or 2 years be looking at the exact same product. I always say you don't want to have that conversation where you've done the hard work to get to a better place financially, but the same product that we're looking at now is what we were looking at then, and there's been no increase. Real estate is a ladder, right? The hardest part is getting on. And then once you get on, you put together a strategy to how you move up based on what you need. And I think that's the piece that sometimes the advice might feel a little bit like pressure, but it's really just understanding that we don't want people to miss an opportunity to get on the ladder. Okay, so spring market is a time that we really have to get creative in being competitive. Are there certain loan products that you really think are going to be kind of coming back into this market and really helping your clients to be successful in these types of markets?
Yeah, I mean, we're seeing an expansion of lending options now that we haven't seen, in way back because we're seasoned.
He just said we're old. Note this.
Yes.
I think I look good for old.
We're going to move on. Lending products before, the liar loan world, that stuff is gone.
Yeah.
Lending is opening up to allow people a lot more options that didn't have options before. And what I mean by that, tons of self-employed people that because of the way the tax rules work, they don't report any income when they make a ton. We have things like bank statement loans. We have things like bank statement loans where we can average their deposits into their bank statements.
Okay.
And that's how we generate income, right? We have asset-based loans now that are way more common sense than they were before.
We did a trust loan last year too.
For that particular buyer needed some anonymity. Mm-hmm. So we were able to do a land trust.
Yep.
Right. Which in Illinois land trust is something it's literally called an Illinois land trust.
Yep.
You could buy in California and it's an Illinois land trust. It allows someone to buy completely anonymously.
Yep.
Right. Which is good for some people. Some people need it. Celebrities use it all the time. Athletes use it all the time. There are DSCR loans for people that are real estate investment people. That's debt service coverage ratio. We don't care about anything else other than the rental property,
the money that comes in.
Right?
Yep.
Those kinds of special programs, you do pay a little bit more in interest rate, but you couldn't do it before, and now you can do it. So it's things like that, right? And then I would say too, like when we talk about being prepared for the spring market, if you have someone who for whatever reason, we're doing a lot of loans right now for wealthy people that don't, they have trusts, right? Their assets are held in trusts. We can set up trust distributions for people as their income source.
Yep. No,
and that stuff,
we've done that a couple of times.
That stuff wasn't there before.
Yep.
Right. Retired people, they have a ton of money in retirement accounts. We can set up IRA distributions at a certain pace that's their income moving forward that allows them to qualify. So the options that are out there are plentiful. And I think if someone's having doubts if they can fit, because maybe they are in that different box, that's the conversation to have with us.
Well, and I think the other part of that question would probably go into, I know that the programs that we use that rate has, that a lot of companies don't have, there's also that element of this, that you guys have certain programs that can help our clients succeed that maybe are more useful in Q1 and Q2 that we end up putting kind of in the back of the shelf in the second half of the year. I'm assuming you guys are still doing your lock and roll.
Yep.
So that's the program that essentially you can cap the ceiling of the market when we have some volatility.
Yeah, you can shop for 60 days with a known interest rate.
Yeah. So if we think that there's some negative news coming down the pipeline, we can kind of lock that in, make sure we don't go above that. Obviously, there's some opportunities to still go below that, which is great.
Yep.
I believe you guys are still doing the full approval.
Yeah, that's a full credit approval.
Yeah.
Where instead of a pre-approval letter, we're done with underwriting.
Yep.
Right? And we issue a commitment letter with your offer.
So the important thing on that is in a competitive situation, we can write a cash offer that is still subject to getting a mortgage, but not contingent on the mortgage, which is going to be a lot stronger than an offer with a mortgage contingency, which once again, that can be something that really becomes more important as we go through there.
Yep.
For certain. Because those are the tools, as I say, sometimes we got to wipe the dust off a little bit. We don't use them as much in the second half of the year, but for certain coming out swinging, we need them.
Lock and roll, for example, we used a ton because we knew rates were going up, right? If we think rates are going to be stagnant, why not cap it?
Yeah.
Right? Because then, as we said, if rates drop a quarter point during that little window, right, we can drop your rate for you.
Okay, and I want to jump into one last question because this is one that we get a lot, and it's a very kind of a muddy water strategy that we need to kind of look into. What is the best way to buy and sell in a competitive market? We're doing both sides. We need to do them. How do we do that best in a competitive market? And what are some of the common mistakes that we see? Something
we've never had, but we really never used or whatever, very hard to source bridge loans. So someone that can buy before they sell, right? If someone can buy before they sell and they have a ton of equity, they can now borrow off of that, right? Which is that's not buying and then selling, that's buying before they sell.
Well, we should let's take it even a further step back, right? When you're buying and selling, it gets a little bit more complicated because the selling part in a market like this tends to be the easiest part, right? It's finding that next property.
Yeah.
And there's a lot of people that cannot afford to buy the next property without selling the first property from that perspective. So with that being said, we have to get creative on either what we can do with them financially or logistically to make it happen. Now, you're saying a bridge loan is something that in the past we've really kind of steered away from because they're kind of not always the best of products, but that perhaps there's some products that are maybe becoming a little bit more compelling.
A lot of times if we have people who want to buy before they sell, they need equity, or they don't have the equity, or they don't have the income to do it. Oftentimes we throw in non-occupant co-borrowers, right? Some like a parent or a child or a sibling that will lend their income, lend their credit to get them over the hump to allow them to buy.
Yep.
And then when they sell, they can take them off the title. They'll still be on the mortgage, and then we refi them off the mortgage when time makes sense. So we do that all the time. For people.
Yeah. And there's certain things. And sometimes we don't have that ability, right? Sometimes we have to get a little bit more logistical with the fact of, putting it on the market, knowing what we want to buy, getting creative with rent backs and all that stuff. And we do have those tools, but I think it's important to note, I think a lot of sellers are nervous to take on the market because they just think I'm not in a financial position to buy without selling. And I certainly don't want to be homeless. I think the takeaway from this is that don't talk yourself out of it just yet. Have a conversation. Let's figure out what the pieces look like, and then let's make an educated decision on whether or not this is the market for you. Also, sometimes we have those people that we say, okay, well, maybe Q1 or Q2 doesn't make as much sense. Maybe you're a Q3 or Q4 buyer, which we have that. And that all comes from conversation. We have to talk about these things. We have to understand these things so that once again, we are able to put the strategy in place. But I think what you're saying is that there are so many tools now. There are so many creative things that we're doing, and we have the ability to really help people in ways that we haven't in the past.
Similar to when you're sick and you Google how you feel. You're going to find really upsetting things, right? You're going to find stuff that's like, yes, horrible. You'll do the same thing if you are afraid to buy before you sell, right? Or to do things like that. So having conversations with the professional people who do this a lot every day, it's huge because it will bring, I mean, as you 100% have had people that they back themselves off the ledge, right? They're like, oh my God, totally cool doing it this way.
We got this.
Right. So it's having the conversations with us, and it makes things way better.
Well, people, you heard it here first. We're going to see a lot of interesting adventures in the new year. Dan, I can't thank you enough for being here.
Thanks for having me.
are a daily asset to my life. I appreciate you sharing your wisdom with all of the people that are tuning in. Until next time, Chicago.